What if I told you that building a $100,000 investment portfolio is not reserved for rich people, finance experts, or Wall Street insiders? What if an ordinary person, starting with $0 invested today, could realistically build a six-figure portfolio by following a simple plan? In this video, I'm going to show you exactly how I would build a $100,000 portfolio from scratch if I had to start all over again. No complicated strategies, no risky gambling, no get-rich-quick schemes. Just a step-by-step roadmap that focuses on consistency, smart investing, and long-term wealth building. Let's get started. Section 1. The biggest mistake people make. Before talking about investments, we need to address the biggest mistake most people make. They think investing is about finding the perfect stock, the perfect crypto, the perfect opportunity, but the truth is, wealth is rarely built through one lucky investment. It's built through a system. Most people spend years looking for shortcuts while ignoring the simple habits that actually create wealth. The reality is that your portfolio grows because of three things: the amount you invest, the time you stay invested, and the return your investments generate. That's it. Everything else is noise. So if I were starting from zero, I wouldn't waste time chasing the next hot trend. I'd focus on building a strong foundation. Section 2. Step 1. Build an emergency fund. Before investing a single dollar, I would create an emergency fund. Why? Because life happens. Cars break down. Medical bills appear. Unexpected expenses show up when you least expect them. Without an emergency fund, every surprise becomes a reason to sell investments. And selling investments at the wrong time can destroy years of progress. I would aim for 3 to 6 months of living expenses in a high-yield savings account. Not in stocks, not in crypto, not in risky assets, cash. Once that safety net is in place, then I can start investing with confidence. Section 3. Step 2. Pay off high-interest debt. If I had credit card debt charging 20% interest, I would attack that debt aggressively. Why? Because earning 10% in the stock market means nothing if you're paying 20% in interest. Paying off high-interest debt is often the best guaranteed return available. Think of it this way. If you eliminate a 20% interest payment, it's like earning 20% on your money with zero risk. That's hard to beat. So before building wealth, I would remove the biggest obstacle standing in the way. Section 4. Step 3. Invest the first $100. Now let's assume I have no high-interest debt and a solid emergency fund. I have my first $100 ready to invest. Where would I put it? Into a broad market index fund. Not individual stocks, not options, not meme stocks. An index fund gives me ownership in hundreds or even thousands of companies at once. This instantly provides diversification. If one company struggles, the entire portfolio isn't destroyed. Historically, broad market index funds have generated strong long-term returns while requiring very little maintenance. This is where my journey begins. Section 5. Why I wouldn't pick individual stocks. Many beginners believe stock picking is the fastest way to get rich. The problem: most professionals fail to consistently beat the market. And if professionals struggle, beginners face an even bigger challenge. That's why I would spend less time trying to find the next big winner and more time buying the market itself. The market already contains the biggest companies in the world. As successful companies grow, my investment grows with them. It's simple, it's boring, and that's exactly why it works. Section 6. The power of consistency. Let's imagine I invest $500 every month. Not once, not twice, every single month. Rain or shine, bull market or bear market, good news or bad news, I keep investing. This strategy is known as dollar cost averaging. When prices are high, I buy fewer shares. When prices are low, I buy more shares. Over time, this removes emotion from investing. Instead of trying to predict the market, I focus on staying consistent. Consistency beats timing for most investors. Section 7. How compounding changes everything. Now let's talk about the real magic. Compounding. Compounding is when your money earns returns, and those returns begin earning returns too. Imagine a snowball rolling down a hill. At first, growth is slow. But as the snowball gets larger, growth accelerates. That's exactly how investing works. In the early years, progress feels small. Then suddenly the portfolio starts growing much faster. The longer you stay invested, the more powerful compounding becomes. This is why time is often more important than the amount invested. Section 8. Reaching the first $10,000. The first $10,000 is often the hardest milestone. Not because it's technically difficult. Because it requires discipline. At this stage, most growth comes from contributions rather than investment gains. This is where many people quit. They don't see massive results immediately. But this is the stage where wealth is actually being built. The habits formed during the first $10,000 determine everything that comes later. So I would focus on consistency rather than results. Section 9. From $10,000 to $50,000. Once the portfolio reaches $10,000, something interesting starts happening. Investment gains become more noticeable. The market begins contributing meaningful growth. Instead of relying entirely on new contributions, the portfolio starts helping itself grow. At this stage, I would continue investing aggressively. I wouldn't increase risk. I wouldn't start gambling. I would stay with the same strategy. Because the goal isn't excitement. The goal is wealth. Section 10. Avoiding common mistakes. If I were rebuilding from zero, there are several mistakes I would avoid. Checking my portfolio every day. Trying to time market crashes. Following random social media investment advice. Panic selling during market downturns. And chasing investments simply because everyone else is talking about them. Most investing mistakes come from emotions. Fear, greed, impatience. The more emotional decisions you make, the worse your results usually become. Section 11. The importance of income growth. Investing is powerful, but increasing income can accelerate the process dramatically. If I wanted to reach $100,000 faster, I wouldn't just focus on investments. I'd focus on earning more money, learning valuable skills, starting a side hustle, building additional income streams. Every extra dollar earned can become another dollar invested. The combination of increasing income and consistent investing is incredibly powerful. Section 12. Market crashes are opportunities. Most investors fear market crashes. I would welcome them. Why? Because market declines allow me to buy assets at lower prices. When stores offer discounts, people get excited. But when stocks go on sale, people panic. That's backwards. As a long-term investor, temporary declines are opportunities, not disasters. The key is staying calm and continuing to invest. Section 13. Reaching $100,000. Eventually, through consistent investing, compounding, and patience, the portfolio reaches $100,000. This is a huge milestone. But something important happens at this point. The portfolio begins working harder than ever. A 10% gain on $1,000 is only $100. A 10% gain on $100,000 is $10,000. The larger the portfolio becomes, the more powerful growth becomes. That's why the first $100,000 is often considered the hardest. After that, momentum starts building. Section 14. The real secret. So what's the secret to building a $100,000 portfolio from zero? It's not intelligence. It's not luck. It's not finding the perfect stock. The secret is staying invested. Most people underestimate what they can achieve in 10 years. Because they focus on today's results instead of long-term progress. Wealth is built gradually, then suddenly. The people who win are usually the ones who refuse to quit. If I had to start over from zero today, this is exactly how I would build a $100,000 portfolio. Build an emergency fund. Eliminate high-interest debt. Invest consistently. Use broad market index funds. Stay patient. Ignore the noise. And let compounding do the heavy lifting. Because building wealth isn't about getting rich overnight. It's about making smart decisions repeatedly until success becomes inevitable. And the best time to start? Today.